Right, let's connect then with Digant Haria, who is joining in on the show. Hi there, Digant. Lots to chat about. Wondering first up if you plan to get your hands on any of the cool launches by Apple at their latest event, the iPhone 16.
Morning, Avna. Thank you for having me here. I'm still, an Android person, not moved to the Apple ecosystem. So, and I think it's working fine for me. So, yeah, I'll just watch the Apple fun, but I'll still be with Android.
Okay, fair enough. That's where your preferences lie. But where do your preferences lie in the markets, especially when it comes to the banking sector? Just wondering what the outlook is, given the fact that the expectation is that credit costs are going to normalize, valuations as well as compared to the 10-year average are at about a 14 to even a 45% discount. Where is it that you're finding comfort within banks?
Yeah, so see, this sector has been underperforming since almost say last 12 months. 12 months back, we were all feeling that the earnings have peaked out. But even 12 months back, the valuations were quite reasonable. Now today, there's this new deposit growth problem which has come, and because there is not enough deposits in the system, the growth, the loan growth has slowed down, so we are seeing one more round of derating happening in the banks. And see, all this is happening when the markets are, really vibrant and they are surprising all of us each day, each week, each month. So it's a paradox in that sense that the largest sector is not doing well despite cheap valuations. But Amna, see, we have seen in the past that these liquidity flywheels, when they are against you, the sector takes a long time to bottom out. I think the sector is healthy. The credit cost uptick, I am not too worried about credit costs going up, except for microfinance and very small ticket personal loans. I think we are still very healthy. Interest rates will peak out in India, or probably have peaked out, and we will see some easing of liquidity. So I think this sector will give a 10-20% of upside as a macro trade in the next 6 months. But till then, what we are doing is we're just playing some turnaround stories here and there, things like, say, a JM Financial or a Religare, where, we really don't have to do much with the margins and the credit cost. Or, something like a gold finance or a vehicle finance, which is secured lending, and where the macros are good, demand is good, there's no margin compression. So yeah, this sector is very large, but right now we are restricted to a small pockets because the macro is not very favorable. I think in 3 to 6 months that should change, and then the large PSU private banks, everything will become a play, but that's not the day to day.
Okay, that's not the day today, but
The trade historically is dollar index goes down, you go long on commodities. What is playing out is the dollar index is going down and commodities are also going down. Do you think the historical correlations are getting broken, or it's a matter of time we could see a V-shaped rally in commodities?
Nikunj, spot on. I think, see, these long term correlations don't break over a long term, right? So, right now, there is this whole China factor, the China slowdown, and less demand from China, which is probably weighing on these commodities. Otherwise, dollar index going down and commodities going up has been a very long term trade. I think that still will play out because if you look at the entire mining sector, okay, be it copper, be it zinc, be it iron ore, there's no big investment which has happened in the mining sector in the last 15 years. Even gold, silver, the mining output is really pathetic, and no capex has gone there. So I just think it's a matter of time that we will see a V-shaped recovery or an extended long bull market in commodities. So we are very excited on this entire commodity trade, and the current correction, be it companies like Moil, Nalco, or NMDC, Coal India, we are quite bullish on commodities because that bull run is not going anywhere. I think global inflation has still not been tamed. US is talking about cutting interest rates even when the inflation has not been tamed. It just shows that the problem is more with the US and less with the rest of the world.
I'm just going to break up the setup here and then we'll get Digant to comment on it. I'm just breaking it for our viewers here. The fuel for banks is deposits, and the fuel for NBFCs is the borrowing from the wholesale market. Wholesale market means you're borrowing from the debt market. Wholesale borrowing means that you're borrowing from corporates. If interest rates they come down, cost of wholesale borrowing it comes down immediately. But the cost at which you're lending, if you're an NBFC, it comes down in a gradual manner, which is that when interest rates come down, the first big beneficiary would be NBFCs, and especially those who are dependent on wholesale borrowing. And interest rates will come down. That is what the bond yields have started indicating. Even if RBI does not cut interest rates, 10-year paper now seems to be tilting more towards 6 rather than 6.5, or towards 7, certainly not. So Digant, if one works with an assumption, which is a realistic assumption, that for the first time post-COVID rates will come down, the weather around us is changing. If weather is changing, you need to invest differently because interest rates are changing. Should one go and simply buy wholesale NBFC stocks?
See, I think most of the NBFCs are, after ILFS of 2018-19, the ILFS crisis, most NBFCs have a reasonably balanced kind of portfolio where bank borrowings is a large part and the wholesale market is a smaller part. Because see, the mutual funds actually went off the market in a reasonably big way, went off the debt market in a reasonably big way. So I just feel that the interest rate or the margin benefit which the NBFCs will have, it'll be certainly more than the banks, but it'll not be as sharp as say it used to be in those 2013 to 18 or 2013 to 19 days. But yes, even then I would still say that in NBFCs we would stick to say a commercial vehicle finance and the gold loan finance NBFCs. Right now, once this interest rate starts coming down, housing finance will be the biggest immediate beneficiary. So something like an LIC housing on the PSU side, and on the private side, one new IPO is also currently going on, which is the Bajaj housing. So something like that can easily give 15, 20, some good returns to the investors. So you're right that interest rate goes down, housing finance is the first beneficiary. And yeah, I would still not go to like a diversified NBFCs like say an Aditya Birla Capital or a Piramal, because there the business models are still getting established.
What's your view on Bajaj housing finance? It amazes me that this is not even a 10-year-old company and it has become the second largest. And I was looking at the data, low on NPAs and high on growth, and on a large base of 1 lakh crore, it is growing at 25%, double than of the industry average. What should one do? IPO is open right now. Subscribe, avoid.
Sector exposure, this is the best bet. So Nikunj, you see that there is some bit of luck also. HDFC Limited has got merged with HDFC Bank. So the largest housing finance company is no longer existing. Then the next two ones, PNB and LIC, these are, quasi PSU slash, those kind of companies. So if one really wants a nice private sector player which is growing, it has to be Bajaj Housing. And see, they always had the benefit of raw material at a lower cost. They can borrow between 7 and 8%. And that is a huge advantage. And see, and see, after ILFS Nikunj, this housing finance as a business model, the ROEs have come down from 18% to 15%. And Bajaj Finance is right there at 15%. They have a very well balanced mix of four products, which is LRDs, the builder loans, affordable housing, and the LAP. So I think that they are doing quite well. They're ticking all the boxes, and somebody wanting to play the housing finance story, Bajaj Finance is your go-to bet. At least it's mine go-to bet. I can, I can say that investors may also look at it because it ticks all the boxes.
Okay, fair enough. That's the view coming in on Bajaj Housing Finance. But wanted to understand your take as well as on the entire IT space, because there are some reports talking about macro uncertainty impacting the entire IT space in the near to medium term. Is that a concern? And if so, how would you play IT?
So see, it's been quite a confusing time for the last 1 year because the traditional long-term correlation has been when US and Europe does not do very well, the large cap IT especially should not do very well. But now we have been hearing that it may not be so bad, and so honestly it's not a straightforward bet for us. We are still not very sure of what is backing this whole rally. Is it just the liquidity and relatively lower valuations, or is it an improved demand environment? We did not get much clear answers from the result season or the management commentaries. And it's already very clear that, the small cap or the mid cap IT, they're quite expensive. And, we could be in for more disappointments there. So we are still staying underweight on this sector, not, one or two bets here and there, but not really focusing much there. I think the next 6 months, the banking sector should give a bigger macro upside versus the IT sector.
Banks versus IT, banks are likely to top it. But Digant, what about insurance? Were you disappointed that there was no relaxation in GST yesterday?
See, to be honest, I think that there's a lot of revenue which the government has to forego. And see, in some ways, the government still thinks. See, this general insurance, health insurance. See, the penetration levels in India are still, say, 6% or thereabouts. So it is safe to assume that it is only the middle class and the affluent class who is actually buying the insurance. And for rest of the country, there is this Ayushman Bharat, a lot of these government-backed schemes, which are anyways not very expensive. So I think government is dilly-dallying here in terms of letting go of their 5 or 6,000 crores of revenue which they get from the taxes on these policies. So I was not very sure if this happens today, but even then I think the insurance sector is on an up move. The life insurance piece, because most of those regulations around surrender policy values and the last 2 years have been a lot of regulatory tightening. So I think that is behind us. We'll see good amount of growth even without this GST tax cut. So I think it's a good time for the health insurers and the general insurers and the life insurers, all of them right now. And whenever this tax cuts, if it comes, that will be a bonus. So we are still positive on this. Say, something like a Lombard or a Religare, which has this care health insurance inside it.
That note, Digant, we'll let you go. Thanks so much for making time and speaking with us today. But the other
If you like this video, then like, share and subscribe to ET Now.